Madhur, who's senior global economist at Standard Chartered Bank, joins us on the show with her perspective. Madhur, good to have you on the show. How are you looking at the post-tapering macro environment for developed markets versus emerging markets now?
Definitely 2014 should turn out to be a better year. We're looking for global growth to actually pick up to about 3.5%. And so far, emerging markets have done quite well. They've shown robust growth, and the expectation of better growth globally in 2014 is really based on the developed world continuing to do well. And I think it's important to remember that tapering has started because the US economy is doing better. If the Fed had felt that the US economy was going to continue to be weak, they would not be trying to remove monetary accommodation. So we're definitely more optimistic about the global growth and developed world outlook.
Although many believe that US growth is now getting discounted, and the big talking point in 2014 will not be US, it will be Europe, and how Eurozone from the low crisis, from the low point of crisis with countries like Italy and Spain are bouncing back. What are your thoughts? What could be the important trigger for 2014, US or Europe?
I would certainly agree with that. We would put ourselves on the more optimistic end of the spectrum when it comes to the Eurozone. Clearly, there are a lot of concerns still. The recovery is still very fragile. But there are three reasons why we think the Euro area is going to see some positive growth next year. We're looking for 1.3% growth in 2014 and even more than 2% growth in 2015 compared to recession last year. And really the three reasons are, first, for the Euro area as a whole, a lot of the fiscal tightening has come to an end. The fiscal deficit for the Euro area as a whole has come down from something like 7% in 2009 to closer to 2.5%. So many countries are seeing an end to fiscal austerity coming through, and that should support growth. The second reason, of course, a lot of the trading partners of the Euro area are doing better, so export growth should pick up, and that's going to again support growth. So global growth will help the Euro area story as well. And the third reason is that generally worries about the Euro area breakup have receded. You are seeing a lot more positive sentiment in terms of the consumers as well as the businesses, and that should really support investment spending coming through. Investments have fallen by 20% since the start of the crisis in the Euro area, and that should start to recover over the course of 2014. So all these three factors combined, really we are looking for the Euro area to start showing some signs of recovery and to continue to grow from here on.
Madhur, in India, the RBI has kept rates on hold to assess the macro situation, particularly on inflation. How do you view this move? The governor believes he shouldn't err on the side of over-tightening. You agree?
Yes, I think the RBI has been shifting its stance away from inflation towards growth since its October meeting. They have shown that they would like to support growth a little bit more. Also, I think it's important to remember that some of the spike you saw in inflation in November was because of the impact of the Hurricane Phelan. And you've had vegetable prices rise, and so that's supposed to start correcting. And what the RBI governor has indicated is that if you do see a substantial correction in CPI inflation, then you should see policy remain on hold. And we would expect that to happen over the coming months. So clearly it's very data dependent over the next few months. We are expecting inflation to moderate, but the risk very much remains that inflation is still too high. Definitely it might breach the 9% target for March 2014 that Mr. Rajan had announced earlier, and so we still think that the risk of another 25 basis points rate hike is still very much there. But as of now, we think inflation will come off, and that will allow the RBI to maintain its focus on growth.
Madhur, what is your call on India macros and rupee for 2014?
Well, India has been the laggard of all the Asian economies. As you know, Asia has been the strongest performer over the last few years in terms of growth. India has disappointed, and till we get the election results, we think that you will continue to see the economy muddling through. Not much change is going to come through. We are looking for a slight improvement in growth in 2014 to about 5.3% from to 4.7% in 2013. So it's a very slight improvement. but it's still well below potential. And really, the focus will be on whether we can get a stable government that can push through reforms, because that's really key to be able to get India to reach its potential growth rate of 6% or even 8% that people think structural reforms will be able to enable India to reach. In terms of the rupee outlook, we do expect that the rupee will remain weaker than historical norms because of the fact that there's a lot of uncertainty related to the elections and policies. But however, there will be increased inflows coming through because of various measures taken by the RBI and also improved global growth environment. And that's why it will be slightly stronger than 2013, but really quite weak, around 60 levels on a historical basis still remains quite weak.
Right. Finally, Madhur, what is your outlook on the twin deficit situation in India? The FM has said CAD would come in below $50 billion. That's the latest target there, with gold and crude being soft. What do you expect on the CAD targets as also the fiscal deficit?
Yes, we definitely expect. We've already seen quite a substantial improvement in the current account position in India. It's partly relates to the fact that export performance has picked up. You've seen pretty strong export growth, partly because global growth is picking up, but also because the rupee has been weak and that has supported exports. At the same time, imports have fallen primarily because of the slowdown in gold imports. And so compared to just under 5% current account deficit in 2012, this year for 2013, you should see a current account deficit much smaller of about 2.5%. Next year, 2014, as growth picks up slightly, import growth will pick up. And so the current account will widen out to around 2.8%. But still, that is still more moderate. The fiscal deficit still remains high, around 5%. But we do expect the government will continue to focus on bringing the fiscal deficit under control. And by next year, we're expecting the fiscal deficit to continue to moderate to about 4.2%, partly because as growth picks up, your revenue should rise, but also because the government is trying to bring in fiscal consolidation, and that again should have a positive impact on the fiscal situation.